This graph tracks the steady downward drag of inflation on your purchasing power. When we layer on a compounding growth line, we see the point where a portfolio intersects and outpaces that loss. To generate that momentum, you rely on three asset classes: business equity through stocks, debt instruments through bonds, and tangible property like real estate. It is important to distinguish the asset from the account holding it. A 401k or a robo-advisor is the shopping cart. The actual engines of wealth are the stocks and bonds you place inside it. Beating inflation requires looking past the account name on your statement to understand the unique mechanics and risks of the specific assets doing the work. Buying a stock means purchasing a fractional ownership stake in a company. While the historical returns are high, this ticker shedding 778 points illustrates the price volatility inherent in the equity markets. This scatterplot shows the relationship between risk and reward. Picking individual companies steps in the upper right, while broad index funds, or ETFs, that track the entire market provide a more optimized position in the middle. Bonds sit on the opposite end of the spectrum. When you buy a bond, you are lending your capital to a corporation or government in exchange for interest, resulting in a smoother but lower return path. This teeter-totter diagram shows the mechanical quirk of debt. An inverse relationship exists between market interest rates and a bond's resale value. If interest rates rise on the left, the resale price of your existing bond drops on the right. Both stocks and bonds offer high liquidity, allowing you to buy or sell in seconds. Success requires balancing the aggressive growth of equities against the stabilizing gravity of debt. Real estate introduces a specific mechanical advantage over standard paper markets: leverage. This scale shows how that works. Having $25,000 in cash limits you to buying $25,000 worth of stocks. But placing that same cash down as a property deposit allows you to use bank debt to control a $125,000 physical asset. That advantage involves a trade-off. Paper markets allow for instant liquidation, whereas selling a house takes months and requires manual labor to maintain. This data table illustrates the 1% rule, a common test used to verify property viability. A $100,000 house must generate at least $1,000 in monthly rent to be considered sustainable. Real estate investment trusts, or REITs, provide a paper alternative. These allow you to buy shares in property pools, exchanging physical labor for stock market liquidity. Direct property management functions as a highly leveraged second job rather than a passive holding. Consider a real-world scenario. You have $5,000 to invest, limited free time, and a 10-year timeline. For those specific constraints, a passive index fund is often the optimal choice. This ticker reflects the upward momentum of the broad market, which you can capture without the friction of property management. This donut chart shows how professionals manage scale, splitting capital across stock ETFs, bonds, and REITs. It acts as a shock absorber. When a downturn shrinks the equity slice, the predictable income of bonds stabilizes the entire portfolio. This matrix table summarizes the specific trade-offs of the big three. Stocks provide liquidity and return at the cost of volatility. Real estate offers leverage at the cost of effort. Bonds buy you stability by sacrificing return. Total portfolio mastery relies on building an automated, diversified machine that outpaces inflation while you sleep.